For years, ordinary investors were given the same advice: don't try to beat Wall Street, don't pick stocks, don't chase hot tips. Buy the index, stay passive, contribute regularly to your retirement account, and let the market do its job. That was genuinely good advice until Wall Street found a way to make passive money useful too. So what happens when the index itself turns into an exit door? What happens while insiders cash out, private equity investors free up billions of dollars, and ordinary retirement accounts quietly keep buying, not because anyone examined the company and found the price attractive, but simply because the benchmark index changed? This is where money, power, and history collide, and nothing is as simple as it looks. This is the story of how passive investing, one of the most boring ideas in finance, turned into one of the most powerful mechanisms in the market. And being boring is exactly why it works. Nobody thinks about plumbing until the house floods. In the same way, nobody thinks about index rules, fund rebalancing, free float ratios, lockup periods, or benchmark methodology. These terms sound like they were designed to make people leave the room. But that's exactly where the real power hides. The modern financial system no longer needs you to actively buy at the top. Millions of retail investors don't need to wake up, open an app, and decide to buy into an overvalued company. Sometimes all it takes is for that company to be added to an index. Funds tracking that index buy automatically. If your retirement account holds those funds, congratulations, you're now carrying that risk too. Not because you chose it, but because the structure chose it for you. To understand why this matters, let's start with an old bubble. In the 1920s, Wall Street needed direct public participation. Ordinary investors bought stocks on margin, that is, they borrowed money to buy shares, sometimes paying only a small fraction of the purchase price up front and financing the rest with credit. As prices rose, everyone got richer. Brokerages profited, banks profited, the market seemed unstoppable. Then prices fell, margin calls arrived, forced selling began, and the crowd learned that leverage is only fun on the way up. The same pattern repeated in the dot-com bubble of the late 1990s. Individual investors chased internet stocks and IPOs. The pitch was simple: this is your chance to own the future. And the fact that the internet genuinely was the future is exactly what made the bubble so convincing. The problem wasn't that the technology was fake. The problem was that prices assumed every company with a website would become an empire. Then came 2008. This time the public didn't even need to buy individual mortgage bonds directly. The system had become far more efficient. Mortgage risk was packaged, rated, sliced, insured, leveraged, and distributed throughout the financial system. The average homeowner didn't understand the mechanism. The average pension fund couldn't see the individual loans underneath the securities, but the risk moved anyway. This is how modern finance evolves, by turning individual decisions into automatic flows, and the cycle keeps going. Today, the public doesn't even need to closely follow every exciting IPO. A company can stay private for years, raising money from venture capital, sovereign wealth funds, private equity, employees, founders, and strategic partners, reaching a massive valuation, and only go public once early investors need cash. Cash is the only word for turning paper wealth into real money. And in the private market, that's not always easy. You can be rich on paper and still need someone to buy your shares. That buyer used to be an excited retail investor. Increasingly, it's an index. Let's simplify the mechanism. An index fund is a fund that tracks a specific list. The S&P 500 tracks roughly 500 large U.S. companies. The NASDAQ 100 tracks the 100 largest non-financial companies listed on the NASDAQ. ETFs like QQQ track indexes like these, and target date retirement funds usually hold broad index funds underneath. The investor thinks they own the market, but the market isn't a force of nature, it's a list. And someone decides who gets on that list. When a company is added to a major index, funds tracking that index generally have to buy it. Not because the stock is cheap, not because a manager believes in it, and certainly not because the employees contributing to their retirement accounts examine the balance sheet the fund buys, because its job is to replicate the benchmark exactly. That's the essence of passive investing. That's also why inclusion in an index is so valuable. It creates automatic demand. And automatic demand is extremely valuable to insiders sitting on large amounts of stock who need a buyer. Add to this the fact that companies are staying private for longer, and the picture changes further. The biggest growth spurts and the most exclusive investment opportunities now usually happen long before the public gets to participate. By the time a company finally goes public, it may already be enormous. The public doesn't get in on the early stage, it's more often participating in a cash-out event. That distinction matters. A healthy IPO can raise capital, expand operations, and give ordinary investors access to a genuinely good business. But under bubble conditions, an IPO can become the moment private wealth transfers onto public markets and gets converted into cash. The story gets marketed as democratic access, while in reality the public is invited in only after the valuation has already done its heaviest lifting. This is exactly why today's AI and megatech IPO wave is drawing so much attention. SpaceX became a case study on this in 2026. It went public at one of the largest valuations ever attempted, and then quickly qualified for fast inclusion in the Nasdaq 100 under updated index rules. Analysts projected that this inclusion could generate roughly $4.3 billion in passive inflows, meaning index tracking funds would have to buy the stock simply because the company had entered the index. Think about that for a moment. Billions of dollars in buying pressure can come not from the market calmly assessing the stock's value and finding it cheap, but from index methodology simply declaring, this company belongs in the basket. That's not illegal. It's not a conspiracy. The machine is working exactly as designed. And that's exactly what makes it so sharp. Before 2026, entering the Nasdaq 100 involved more friction. A newly public company generally had to trade for at least 3 full calendar months before being considered for inclusion, and depending on the index rebalancing schedule, the waiting period could stretch much longer. There was also a baseline free float requirement. At least 10% of the company's shares had to trade freely. In short, the old system said, if you want to enter this major index, you need some trading history, some public liquidity, and enough time for the market to genuinely discover a price. Then, in 2026, Nasdaq changed the rules. Under the new fast entry path, a very large newly public company can be evaluated as early as its 7th trading day and added after the 15th trading day if it meets the criteria. Nasdaq also removed the old 10% minimum free float requirement. Instead of saying, there isn't enough publicly traded stock, so you can't enter, the new approach allows companies with a low free float to enter the index through a weighting adjustment. This might sound like a technical detail, but it actually means a giant company can go public with a limited number of shares, enter a major index very quickly, and trigger automatic buying from funds tracking that index without needing months of trading history or broad public liquidity in the traditional sense. All it needs is size, eligibility, and an open index door. Free float is another boring term with major consequences. It refers to the amount of stock actually available for trading. If a company has a massive valuation but a small amount of freely floating stock, that stock becomes extremely sensitive. A small amount of buying can push the price up, a small amount of selling can push it down. When index funds are forced to buy into a limited pool of shares, post-IPO share releases can create demand pressure before the market has had a genuine chance to test the valuation. And when insiders later start releasing and selling their shares, the public market becomes the place where those sales get absorbed, in other words, the exit door. Lockup periods are part of this picture too, the period after an IPO during which insiders are restricted from selling shares. Traditionally, this lasts around 180 days. The idea is simple: don't let insiders sell right after the public has bought in. But some modern deals use more complex, staggered lockup schedules, where portions of shares become eligible for sale gradually. Reports on SpaceX indicated staggered releases at days 70, 90, 105, 120, and 135, with more shares released around earnings events. None of this means every insider will sell, and it doesn't mean the stock has to crash. But the sequence matters. First, the company goes public at a massive valuation, then index inclusion triggers automatic passive buying. Then insider shares begin unlocking in stages right as the public market becomes deeper, more liquid, and better able to absorb the supply. That's a remarkably convenient timing, much like a lifeboat being ready right after someone has sold you the ship. The concept of exit liquidity carries real weight right here. It means a buyer that allows someone else to get out. If an early investor holds shares at a low-cost basis and wants to sell at a high valuation, they need buyers. In old bubbles, those buyers were usually retail investors caught up in the excitement. In the new structure, some of those buyers can be passive funds, retirement accounts, ETFs, and index-linked products. There's no longer a need to convince individuals one by one. The buying happens automatically through the benchmark index. AI is amplifying this further because the market is already concentrated. JP Morgan estimated that 30 AI-linked companies make up roughly 44% of the S&P 500's total market value. That means AI is no longer just a side, but it's increasingly becoming the market itself. Millions of people who say, "I don't own any AI stocks," may still hold them through broad index investments in retirement accounts, in target date funds, or in products they specifically chose because they didn't want to deal with picking individual stocks. And here lies a real irony. A strategy designed to protect ordinary people from bad individual decisions can still expose them to bad structural outcomes. To be clear, this doesn't mean index funds are bad. Index funds remain one of the best tools available to ordinary investors, low cost, simple, and generally more successful than trying to outguess professionals. The problem isn't passive investing itself. The problem is the assumption that it's neutral. It isn't. It's rule-bound. And rules have consequences. Someone decides which companies qualify. Someone decides how quickly a new company can enter the list. Someone decides how market value is measured. Someone decides how much weight the amount of free-floating stock should carry. These decisions shape where passive money flows, and wherever the money flows, price, liquidity, and power follow. This isn't the democratization of finance, it's the industrialization of exit liquidity. Let's widen the lens a bit. There are reports that OpenAI filed confidentially for a US IPO in 2026, with talk that the process could be delayed if markets can't support the price, and that the company may be targeting a valuation of up to $1 trillion. Anthropic filed following a funding round valued at roughly $965 billion. These aren't ordinary IPOs, they're potentially trillion-dollar private companies trying to enter public markets in the middle of an AI boom. If they succeed, the question won't just be whether ordinary investors want to buy in. The question will be how quickly they enter the indexes, how much passive money will be forced to follow, how many shares insiders will eventually be able to sell, and how much of that risk ends up buried inside funds held by people who have never read a prospectus. That's really the core story here. It's not about one company, one rule, or one ETF, it's about the architecture itself. In the 1920s, the public bought directly on margin. During the dot-com era, it chased IPOs. In 2008, mortgage risk was packaged and distributed through the financial system. Today, private market risk can be funneled into passive public market risk. Each era finds a cleaner channel, and each era sells the same thing: access. You're not buying risk, you're buying access. Access to innovation, to private growth, to the future, to companies once reserved for insiders only. That sounds empowering, and sometimes it genuinely is. But it's worth asking a colder question. Why now? Why is the public invited in only after the valuation has already exploded? Why are employees exposed to this risk through their retirement funds only after insiders have already accumulated enormous paper wealth? Why does democratization always seem to happen exactly when someone needs cash? Financial history isn't particularly subtle about this. The powerful rarely sell risk as risk, they sell it as opportunity. Mortgage-backed securities were sold as safe returns. Internet stocks were sold as the new economy. Cryptocurrencies were sold as liberation from the financial system. AI mega IPOs will be sold as the chance to own the future. The label changes every time. The mechanics stay familiar: someone gets in early, someone sells late, and someone else calls it access. This is exactly where money and power intersect. Because the average worker is always told to be disciplined, contribute from every paycheck, buy the fund, stay the course, don't panic, don't try to time the market. Most of that advice is sound. But discipline can't protect you from a system that quietly changes what you actually own. Staying the course gets a lot harder when the road itself is being redesigned by people who want to manage their own exits. The point here isn't to scare people away from investing. Panic doesn't help anyone. The point is to recognize that the market isn't some neutral object floating above society. It's built by rules, incentives, access, timing, and power. It's shaped by exchanges, index providers, venture capital, investment banks, asset managers, and retirement flows. Most people only see the product. Very few see the infrastructure, and that's exactly where the risk moves. If a company is genuinely strong, fairly valued, profitable, and broadly owned over time, its inclusion in an index can make sense. But when companies go public with excessive valuations, limited share supply, intense hype, insider-driven selling, and automatic passive demand, ordinary investors at least deserve to understand what's actually happening. Because they might not just be buying into an innovation, they might also be buying into someone else's exit plan. Wall Street no longer needs to sell every worker a speculative stock directly. It can hide that risk inside something labeled safe, boring, and responsible. A retirement account should be a tool for financial freedom, but in a system this concentrated, it can also become a warehouse that constantly generates demand. Money arrives every 2 weeks, paycheck after paycheck, contribution after contribution, automatically, quietly, predictably. For an insider looking for cash, there's little more valuable than a buyer who doesn't even realize what they're buying. In old bubbles, insiders waited for the crowd to show up. In the new bubble, the crowd is already there inside the index. When someone tells you passive investing is simple, they're right, and that's exactly where its power lies. But when someone tells you it's neutral, look a little closer. Every index has a door. Every door has rules. Every rule creates winners and losers. And history keeps repeating the same warning every time the public gets invited into a private boom at the tail end of a valuation cycle. Ask who got in first. Ask who needed the liquidity. Ask who decided what goes into the index. Ask who's buying automatically. And when insiders stop calling it opportunity, ask who's still left holding the risk. If this video gave you a new perspective, subscribe. See you in the next one.